Hi friends, if I were to pick 4 to 5 stocks for 2030 portfolio, which can be considered mid to long term time horizon, then I'm going to focus on high growth sectors. This is because in high growth sector, even mediocre companies are likely to do well. Now, I'm not saying that do not consider options, for example, banking stocks or FMCG stocks or auto stocks. These are all evergreen stocks with some cyclicity built in it. But please understand that these companies are unlikely to grow at a rate of, let's say, 25 to 30% CAGR for the next 5 years. Therefore, it makes a lot of sense in my view to focus on high growth sectors. So in this video, I'm going to speak about 4 stock themes that are growing at a very rapid rate and are likely to continue to grow maybe at a rate of, let's say, 25 to 30% for the next 5 years. Throughout the video, I'm going to take a lot of stock examples. These are only examples. Please do not take these as recommendations. My intent is to make this session very practical for you, because every stock tells us a story and we need to grab that opportunity and the story. With that, if you're new to my channel, please do not yet subscribe to my channel. Watch this video completely. And if you gain knowledge, which I'm sure you will, become lifelong subscriber to my channel. With that, shall we get this video cracking? Let's go. So the first sector is capital market and wealth management. I'm going to present to you 2 critical data points so that you understand the opportunities in this particular sector, and then I'll deep dive into few sector specific stocks and where the opportunities are, what are the risks involved in those types of stocks. So have a look at my screen, and the first data point you see here, it is published by Motilal Oswal recently. What you note here is that Indian households, almost 6.9% of the savings they get invested in equities. That is a very small portion of the household savings that are getting into equities. And if you look at the last 10 years of trend here, what you will note is between FY13 and FY19, there was a growth rate in terms of how the Indian households are putting a lot of money into equities, versus if you see after COVID, from FY19 onwards, if you see, the steeper growth is what we have seen, and now we are standing at around 6.9% of Indian household savings getting into equity. So what is right now happening is the financializations of savings of Indian households, because gone were the days when Indians would just store the cash and would not invest. Those days are gone now, and more people are now opting for equities. And when more and more people opt for equities, what happens is that transactions on the exchange goes up. For example, if I show you some data point here, look at BSE's transaction income. In the last 5 years, the income that BSE is getting from the transaction charges has gone up by almost 35% CAGR basis from FY20 to FY25. And this is likely to continue to grow as more and more people opt equity as the investment tool. The second important data point that we need to focus is what Nuvama published very recently, that in India, only 15% of the wealth is professionally managed compared to in US 75%. So there is a huge opportunity when it comes to the wealth management. So I talked about the transaction charges and how India is investing in equity, which comes at the capital market segment, and this talks about the wealth management. So if you put capital market and wealth management together, this sector is likely to see huge growth in the next 5 to 8 years of time frame, and in fact beyond that. So let me now speak about few sector specific stocks so that you get a very good idea of what type of stocks are operating in this particular segment and where should we focus, how should we de-risk our investments. So for example, have a look at my screen, and what you will note is primarily, broadly, there are 4 types of stocks. Number 1 is stocks, for example, exchange. Let's say BSE. NSE is not yet listed. MCX is another example. Again, these are some examples that I picked up to bring you clarity about the types of stocks that operate in this particular segment. So for example, exchanges and depositories and registrars, so BSE, CAMS, CDSL, these are very good companies, and I'll talk about them in a minute. But second type of stocks are AMC businesses, which are your mutual fund houses. For example, Aditya Birla is there, Nippon is there, HDFC is there. There are very good AMCs out there. Third type of stocks are what I call is diversified. They are into capital market and they are also into wealth management. Companies like Motilal Oswal, Nuvama Wealth, Anand Rathi, Jio Financial Services, so on and so forth. And the fourth category is the brokers. For example, Angel One is a listed player. Grow is coming up with their IPO. Zerodha is not yet listed. I don't know whether they will ever get listed, but this is the fourth segment of the stocks. Broadly, these are the 4 categories that operate. Coming back to first type of stocks, which are exchanges and depositories. For example, BSE. BSE. So very recently I talked about BSE's business model on my YouTube community, and I broke down the business model into various aspects. And if I come down and talk about their transaction charges income, the revenues coming from transaction charges, it is around 62% in FY25. Now this makes BSE a very strong stock because it is almost a monopoly or duopoly when NSE gets listed, but more importantly 62% of their revenues are coming from transactions. And in the next 5 to 8 years, the transaction volume on BSE and NSE, in my view, are likely to grow further as more and more people invest in equities. Now, does this mean that we go and buy BSE stock blindly? Absolutely not. You really need to understand when to buy stocks like these, because otherwise you will end up buying these stocks at a very high valuation and you might lose money when the stock all of a sudden corrects. Now, talking about correction, when the stocks like BSE corrects, those are the good opportunities in my view to take bets in such types of stocks. When will these stocks correct? Typically when there is a fear in the market that the transaction volume of companies like BSEs are likely to come down. And there are two primary reasons when the transaction charges or the transaction revenues may come down. Number one is when the stock market is bearish, number of transactions start to come down. That happened in the month of January, February, March. We saw little less transactions by the market, and therefore it is entirely possible that the transaction income might come down. Second is when there is a regulatory intervention. For example, just a couple of days back, SEBI came out with a decision that NSE is going to get Tuesday as the expiry day and BSE is going to get Thursday as the expiry date. So typically what happens is that in the early part of the week, a lot of transactions are done. Therefore, NSE volumes are likely to be going up as compared to BSE. This is a short-term fear, and what happened? Stocks started to correct. So these are the two main triggers where you might see that there is a fear of transaction volume coming down, and therefore it is entirely possible that in short term these stocks might correct. And in my view, when that happens, that may be a good timing to enter into stocks like these. And also secondly, you need to look at the valuations as well, not just the price correction, you also have to look at the valuations. A very crude, rough way of looking at the valuations might be that you look at maybe last 1 year's median PE ratio or 3 years median PE ratio. For example, here you see BSE's last 3 years median PE ratio. The stock has been trading at a median PE of around 69.3. Right now it is above the median PE, and you might say that, you know what, I want to only take entry into stocks like these when the PE ratio has come down the median PE. These are some of the ways where you can go and optimize your investment portfolio. Do not buy any stocks in a haste when it is just going up and you're not having any clue about where the valuations are. Now let's move to second type of stocks, which are AMC businesses, for example Nippon, HDFC, Aditya Birla Sun Life, and so on and so forth. Now if you look at these AMC businesses, and if I talk about the SIP contributions, let's say last 7 or 8 years of data, if you see, SIPs in Indian context has been growing up at a 26% CAGR basis if you do some maths around this. So past tells us that there is a good growth in SIPs, and also in my view, I think SIPs are likely to continue to grow in Indian market. So therefore there is likely to be healthy growth rate that AMCs will see in the next 5 to 8 years. But the problem with AMC businesses is, one, right now the valuations are not very attractive in my view, right? Look at the PE ratio of HDFC AMC, look at the PE ratio of Nippon Life India AMCs, and so on and so forth. So good AMCs, you may not find the valuations attractive all the time, but whenever you find valuations attractive, again, this is not a bad bet at all, this particular segment. But the second big problem with AMC businesses that you need to be aware is that whenever AMC's mutual funds are not outperforming the indexes or the benchmark indexes rather, then what happens is that AMC loses the talking point or the selling point when it is selling and distributing its mutual funds. And when that happens, the growth of an AMC business all of a sudden might see a problem. So for example, let us say HDFC AMC, and they have, let's say, HDFC top 100 mutual fund, which is the large cap fund. And if it does not outperform the Nifty 50, right, for let's say 2 or 3 quarters, all of a sudden in India, what happens is that investors, they look at the last 1 year or 2 years of return history. And what they may do is they may stop investing in that particular mutual fund. And when that happens with a lot of mutual funds within an AMC, all of a sudden that AMC might come under pressure. So that is the risk that you need to be aware of when you are investing in AMC businesses. And in my view, valuations is the second point that you need to look at. Now, if I come down to the third types of stocks, which is diversified, in fact, let me park the third one and let me go into the fourth one now, which is the brokers. I'm not very bullish about broker types of stocks right now because the competitive advantage in this particular segment is no longer there. It is sort of becoming a commodity play right now because when Zerodha started, they started with zero brokerage, and that unique proposition somewhere has lost because a lot of other companies are offering that. And when we speak about the technology, a lot of new brokers are coming up with newer and newer technologies. So there is not a real differentiator within the brokers business. And in my view, it is becoming commodity business. And in the long term, it is entirely possible that these brokers might come under margin pressures, and so on and so forth. So I'm not very bullish on broking segment per se. Coming to the third segment, which is the diversified segment here, which is both capital market and wealth management, I am very, very bullish on this particular segment. For example, if I speak about Motilal Oswal's business revenues, what you will note here as per their Q4 FY25 presentation, that they have a very diverse business segments generating revenues for them. For example, wealth management, capital market, asset and private wealth management, housing finance, treasury investment. In fact, I broke down the entire business model of Motilal Oswal Financial Services on my YouTube community, paid community, and I talked about where the growth is coming from, where the growth is not coming from. But the point is that these are well diversified businesses, and in my view, the risk of losing money becomes limited in diversified businesses because remember, we are talking about 5 years long horizon in terms of the investment, and you want to pick the stocks which are well diversified. Again, another example I can give you here, for example, is Nuvama. Nuvama Wealth, if you look at their latest results, you will note that wealth management, asset services, capital markets, they're into a lot of segments, and each of these segments are growing at a very, very healthy rate here. Therefore, in my view, picking up stocks from the more diversified businesses for 5 years time horizon will make sense. Again, please do not take either Nuvama or Motilal Oswal here recommendations, but these are the types of stocks I am particularly bullish about in this particular entire capital market and wealth management sector. So far, if you're liking this video, I request you to hit the like button, subscribe to my channel, and let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Also, you can consider joining my YouTube community because I break down important assets in a very, very simple language so that you can understand and you can become a better investor over a longer period of time frame. The feedback of this community has been excellent. We have been learning almost on a daily basis as I post almost on a daily basis. With that, let's move to sector number 2. The second sector that is likely to grow at a very, very healthy growth rate by 2030 is semiconductor sector. Have a look at my screen, and majority of you might be aware that India's semiconductor mission that got started in 2021 was started with a 76,000 crores of capital outlay by Indian government. But more importantly, what you may not know is that the businesses, for example, which are going to set up semiconductor facilities, 28 nanometer or lower are going to get 50% of their project costs funded by the government. Therefore, it makes a lot of sense to only focus on those semiconductor companies that are likely to take advantage of this project funding by the Indian government. Again, I'll give you an example of Kaynes Technology. They are going to spend around 3,400 crores of capex for building up their semicon fab, and out of that 3,400 crore, they are likely to get 50% of their project funding by government. So 1,700 crores of capex will be actually claimed back from government. So in my view, point is very, very simple, that you need to look for those semiconductor businesses which are approved by the government and they are likely to take advantage of these capex. Again, Kaynes Technology is not a recommendation. I'll speak about that stock in a minute. We will give you a latest and greatest about that particular company. But the point is that Indian semiconductor companies are likely to grow at a very, very rapid growth rate. In fact, this PLI scheme of 76,000 crore, which translate to around 10 billion US dollars, is the largest commitment by government when it comes to all other sectors. It shows us how much government is serious about this particular sector. So in total, there are 6 companies that have been approved by Indian government. Tata Group has got 2 plants, Tata Group and Power Chip, which is one in Dholera in Gujarat. Second one is in Assam, Tata Electronics. So when it comes to Tata Groups, both these units are going to be under Tata Electronics, and Tata Electronics is not yet a listed company. Okay, Tata Electronics rolls up into Tata Investment Corporation Limited, And the only way to invest in Tata Electronics is via investing in Tata Investment Corporation Limited. But the problem with Tata Investment Corporation Limited is that it is not only a semiconductor business. In fact, they have invested in like 85 companies. It is a lot of things is going on inside this Tata Investment Corporation Limited. So if you're only looking to invest in a pure semiconductor business, then Tata Investment Corporation Limited is not a purely semiconductor business. I hope that point is very, very clear. Then coming to Micron Technologies, it's a US company not listed on India's exchanges. Foxconn HCL joint venture that was very, very recently approved, literally few days back. In Jewar in Uttar Pradesh, they are going to come up with 3,700 crores of fab. And again, this one, if you were to invest, the only choice here is the HCL. But again, HCL is not a semiconductor play, pure play semiconductor business. It's an IT company. We all know about it. That leaves us two companies. One is the CG Power and Kaynes Technology. Again, I'm not giving you a recommendation to invest in these companies. In fact, full disclosure that I am investor in CG Power and I invested a year back almost, looking at the semiconductor theme. But coming back to these two companies, let me now bring you some insights about what are these two companies doing in the semiconductor space. So let me speak about CG Power for a minute. The company operates currently in two segments. One is industrial systems, second is power systems. And you can see the revenues, more or less industrial system is generating more revenues, around 5,400 crores versus 2,598 crores by power systems. Now these are the existing revenue streams for the company. And in FY25, company has done pretty well. Sales have grown up by 23% year on year. Order intake has gone up by 35% year on year. This is very, very important. And the reason I'm telling you this is important is because these existing businesses need to generate cash for the company, because this cash is what company can use potentially to invest in the capital expenditure in the semicon business. It's very, very important for us to understand that point. So company is doing pretty well from that aspect. But if you look at what is right now the P&L statement of this company has been very, very lumpy in terms of generating PAT. For example, FY24, they generated 1,400 crores of PAT. In FY25, it came down to 973 crores of PAT. So there is a lumpiness in their P&L, and that makes a company slightly riskier because there might be all of a sudden a correction in the company that you need to be aware of. The second point that you need to know about their semiconductor business is that by mid-26, they are going to roll out their first chip as per the news. Now, it is not going to immediately give them revenue boost, profitability boost by 2026. In fact, it may take them another year or two for them to start operating on full capacity or 80 to 90% of the capacity. They might be taking a lot of time for them to gear up in terms of the production. So do not expect immediate revenues and profitability coming into this business. That's why I say you have to look at semiconductor businesses from a 2030 lens perspective. Another risk in these companies potentially is that, for example, very, very recently, what happened was I wrote a community post on my community on YouTube, and I was talking about very, very recently, the partners of CG Power in the semicon space is a company called Renesas. It's a Japanese company, and this company's client in US, which is Wolfspeed, a very, very big client, had filed for bankruptcy in US. And there was a fear in the investor community, and it was all there in the news as well, that if Wolfspeed has filed for bankruptcy, then what does it mean to the joint venture between CG Power and Renesas? Is it going to continue or is it going to fall through? These are some of the fears, and stocks might see some sharper corrections immediately. But please understand, these are long-term strategies that you really invest in, and there are of course risks you are taking along the way, and you have to continuously assess these risks, and you need to get some timely updates. So if you want to get these timely updates, you can join my YouTube community. I talk about these timely updates whenever there is a need for me to speak about. Now this is all about CG Power, but let me now move to Kaynes Technology as well. Kaynes Technology is into electronics component manufacturing right now. As you can see on my screen, they are making a lot of electronics components, for example, for automotive, industrial, railways, medical, etc. Right? If you look at company's growth rate, very, very impressive growth rate in the last 4 years. If you look at the revenues going up at 57% CAGR, PAT is going up at around 92% CAGR basis. So there's a huge growth rate that we have seen in this particular company in the last 3 to 4 years. Now, if I talk about the order book of this company, the order book of the company as of FY25 fourth quarter is around 6,500 crores. This is in millions. I've converted that into crores. So the total revenues of the company is around 2700 crores and the order book is around 6500 crores. So almost 2 times of order book. This order book in FY24 was around 4100 crores. So solid growth in the order book is also we can see here. Now, if you look at the Keynes Technology, it's a very high PE stock, and that's a very natural concern of any investor. In fact, I have the same concern. Median PE ratio of this company last 3 years have been around 116. It trades at a very high PE, mainly because there is a growth that is happening in the company in terms of the profit. And EPS is growing at a very high growth rate. And that's why the stock is trading at a very high PE. Now, if you look at the company, this is going to spend around 3400 crores worth of capex in the semicon business. I talked about that in the initial beginning of this particular segment. Out of this, 50% they are going to claim from Indian government because they're going to fall into the 50% category in terms of the PLI, right? Now, if you look at the construction that is happening for their semicon business, the construction is in full swing as per the management commentary, and they are likely to roll out their first chips in the second quarter or the early third quarter of this year, right? So that is likely to be there. And before they exit this year, what they're saying is that we will have significant amount of capacity committed by some reasonably good customers when it comes to semicon business. So again, you cannot really expect immediate revenues coming from the semicon business, but hopefully by the end of FY27, you are likely to see some meaningful contribution to the revenues and profitability, in my view, in this semiconductor business that Keynes Technology is running with. Very recently also they have launched their QIP, literally just 2 days back, 1600 crores of QIP. What does this mean? Their ROE is likely to come down because they are borrowing more and more money here. And they have set, I think 5,625 as the floor price. This is a very psychological mark in terms of the pricing, because when the company is now valued from a QIP perspective at a floor price of 5,625, it becomes a psychological mark. It doesn't mean the price will not come down or go up from here. Of course, all of that is likely to happen. But these are some of the crucial updates you need to know about the semiconductor sector. I've picked up these 2 companies, given you details. None of these are recommendations. All of these comes with a lot of risk. But you need to have a vision. You need to have patience with companies that are operating in semiconductor business, because as I said, it is about 20-30 lens, not short-term 1 month, 2 months sort of a trade. I hope you enjoyed this sort of a commentary. If you did, like the video, let me know in the comments a simple thank you. And also you can consider subscribing to my YouTube channel or the YouTube community, because you're going to learn a lot. With that, let's move to sector number 3 now. Third sector that I want to speak about is defense sector. Be it Operation Sindoor, be it Israel and Iran's war that is going on, be it Ukraine and Russia war. What is it telling you? That world is becoming unsafer day by day. We Indians are surrounded by Chinese, Pakistanis, Bangladeshi, and we have no option other than spending more and more money in our defense. If you look at the defense budget back in 2020, it used to be around 3,37,000 crore, and in FY26 it has gone up to 6,81,000 crore. So within 5 years of time frame, our defense budget has doubled almost. This is a huge spending in India's defense. Now, as per an estimate, by 2047, this budget is likely to go up by 5 times at a very high base. It is likely to go up to 31 lakh crores. Again, I don't know whether that is likely to happen or not by 2047, but the point is that there is increased spending by our government, rightfully so, in the defense sector. Therefore, definitely defense sector becomes an attractive play from an investing perspective as well. But more importantly, what is also happening in defense is there is a big shift happening in the defense in terms of Make in India and buying the defense products from the Indian companies itself. For example, if you look at some data here, in FY23 and 24, our production in defense hit around 1.27 lakh crores. And this is 174% rise since 14 and 15. In fact, India has started to export defense warfares now, and this export has crossed 21,000 crores. It is likely to go up to 50,000 crores by FY29 if I talk about the other data point. Point is very simple, that we are going to spend a lot of money on defense, and a lot of this money will be spent on Indian companies. Another data point here, out of this $21 billion of arm purchases in FY26, $30 billion I mean, majority of this will be from domestic firms. This tells you that there is a big shift in our purchasing process. We are not going to buy everything from France, US or Russia, or for that matter from any other country. We are also looking at bolstering up our domestic firms within India, and we are going to purchase from our Indian companies as well. And again, I'm not going to go very deep into each of these companies because I've created this particular video here very recently, top 3 defense stocks. Please go and watch that video. I've covered HAL there, BEL there, 2 of the PSUs, and I've also covered a private sector company called Solar Industries India Limited. Please watch that video with open minds. It will teach you the business model of these companies. It will teach you a lot about those companies. These are not recommendations. I do not give any stock recommendations. My intent is to tell retail investors what is happening inside a company. Because once you understand the business model and what is happening inside a company, you're likely to make some informed investing decisions. So in my view, third sector is the defense sector. Please go and explore and let me know in the comments if you would like me to create any other videos on defense stocks. I've only covered those 3 at the moment. If you want me to cover, for example, Zen Technologies, or for example, any other stock company, Paras Defense, let me know in the comments. I'll be happy to come up with part 2 of that video as well. With that, let me move to fourth sector, and fourth sector is data center sector. Very recently, I've created this video, data center stocks. Just 3-4 days back, I've created that video. It's still on the channel. Please go and watch that video. I do not want to repeat anything from that particular video. This video itself will give you what is happening in the data center space. What is a data center? What are the business models in there? Which are the companies which are actually building the data centers versus the proxy stocks? A lot of details I've covered in that particular video. Please go and watch that video. You are going to learn a lot. So in total, these are the 4 sectors, but it does not mean that you can ignore other sectors. For example, there is a power sector, EV sector. AI I have not talked about mainly because there are not any companies, Indian companies, that are pure play AI companies. If you're looking for AI companies, then maybe look at the US stock market. I'm going to very soon start talking about the US stock market as well on my community. If you want to join my community, go to my channel, find the join button and be my guest. It is a paid community, but you are going to learn a lot by paying a small fees. With that, I hope you liked this video. If you did like the video, let me know in the comments a simple thank you. I look forward to see you in my next video. Until then, keep rocking.